Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, head of U.S. policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Wednesday, June 4th. Today, we're diving into the intricacies of the 2025 Budget Reconciliation Bill and its implications for markets. Let's get started. The 2025 Budget Reconciliation Bill has been the center of attention in Congress. With a version passed through the House of Representatives, GOP leadership in the Senate is balancing policy priorities from factions within the party. These include fiscal hawks concerned about rising debts, members advocating for Medicaid, those pushing for an increased SALT cap, and others aiming to preserve clean energy tax credits. The House version has a net estimated deficit impact of approximately $3 trillion over 10 years and could push the total deficit to 6.6% of GDP by 2034. The deficit impacts are front-loaded in the first 5 years, while spending cuts are back-loaded in the latter half, which could add upward pressure to term premiums and higher U.S. Treasury yields in the near term. Now, let's delve into the tax cuts. The bill proposes approximately $4 trillion in tax cuts, focusing on the permanent extension of individual components of the Tax Cuts and Jobs Act, or TCJA. It also revives pro-growth business provisions and introduces new tax cuts aligned with President Trump's no-tax agenda. It includes an increase in the SALT deduction, raising the individual cap from $10,000 to $40,000 per household, up to an income of $500,000 annually. On the flip side, the bill's revenue raisers and spending cuts total approximately $1.2 trillion. Key tax increases include a progressive excise tax on net investment income of university endowments and private foundations, as well as a 3.5% excise tax on foreign remittance transfers. But the bulk of this bill's pay-fors come from the spending cuts targeting the Inflation Reduction Act and Medicaid. Changes to Medicaid spending could shift the funding burden to the states, adding pressure to certain state and local government credit and non-for-profit hospital municipal bonds. While the bill is largely an extension of the existing tax code, and tax policy changes have been found to have little correlation with equity market performance, certain sectors could benefit. For example, a basket of stocks that are positively exposed to domestic tax changes has outperformed the Russell 2000 index by 7% over the past year. This basket includes stocks in sectors like industrials, communication services, and energy. As Senate Republicans take up the budget reconciliation tax bill, we caution that material changes to the House version could occur. For example, greater clarity is likely to be gained regarding foreign remittance taxes, while a more tempered approach to the consideration of the Inflation Reduction Act could create tailwinds for clean energy. And the possibility of a lower SALT cap could alter an individual's savings and investment strategies. For a more in-depth discussion at the intersection of policy, markets, and the economy, please ask your Morgan Stanley financial advisor for copies of our most recent U.S. Policy Pulse report. As always, thank you for listening.